Greetings, everyone. The upcoming 15 days could fundamentally transform the silver market. Not months or years from now, the next 15 days. 3 specific catalysts are converging within a time frame so compressed that most investors remain unaware of what's approaching. When these catalysts materialize, the silver market won't have time to adjust gradually. It will gap, it will surge, and the movement from $82 to $200 that sounds implausible today will suddenly appear inevitable. I'm not presenting arbitrary figures for attention. I'm going to demonstrate exactly what these 3 catalysts are, precisely when they're scheduled to occur, exactly why they matter, and exactly how they could create a supply shock so severe that silver's price doubles or more within weeks. This isn't speculation. These are dated events, confirmed announcements, scheduled releases, developments that will occur whether you're prepared or not. Welcome back. If this is your first visit here, subscribe immediately because what I'm about to share could be the most time-sensitive information I've ever presented on this channel. By this video's conclusion, you'll understand the specific dates requiring attention, the specific mechanisms that will drive pricing, and the specific actions you should consider taking before the window closes. This is actionable intelligence, not vague predictions or distant possibilities. This is occurring now. Let me provide an overview of the 3 catalysts before examining each one deeply. Catalyst number 1. The COMEX February delivery period, concluding within the next 15 days, is showing unprecedented demand for physical metal. Catalyst number 2. The Federal Reserve policy announcement scheduled for February 19th could trigger a massive shift in monetary expectations. Catalyst number 3. The implementation deadline for China's expanded silver export restrictions taking full effect on February 25th. Each catalyst alone could move silver 10 to 20%. But they're not occurring in isolation. They're converging within the same 15-day window. When multiple catalysts hit simultaneously in an already tight market, the moves aren't additive, they're multiplicative. A 20% catalyst plus a 20% catalyst plus a 20% catalyst doesn't equal 60%. It equals 100% or 150% because each move feeds into the next, triggering short covering, momentum buying, and physical hoarding that accelerates price action. Let me start with catalyst number 1, the COMEX February delivery period. This is the most technical catalyst, but potentially the most explosive. If you don't understand how COMEX delivery works, let me explain quickly. COMEX is the primary futures exchange for silver in the United States. Traders buy and sell contracts representing 5,000 ounces of silver each. Most contracts are settled in cash. Traders close positions before delivery and take profit or loss in dollars. But some traders, especially recently, are standing for delivery. They're saying, I don't want cash, I want metal. Give me the physical silver. When a trader stands for delivery, COMEX must provide the metal from its registered inventory. Registered inventory is silver sitting in approved vaults allocated for delivery against futures contracts. Here's where it gets interesting. COMEX registered silver is currently at approximately 28 million ounces, the lowest level in years. It has dropped 70% since 2020. The vaults are draining. Now look at what's happening in February. The February delivery period started on January 31st and runs through month's end. As of latest data, over 7,500 contracts have stood for delivery. That's 37.5 million ounces of silver that traders are demanding in physical form. But there are only 28 million ounces in the registered category. Do you see the problem? Traders are demanding more silver than exists in the delivery pipeline. How is COMEX handling this? They're moving silver from the eligible category to the registered category. Eligible silver is metal sitting in vaults, but not allocated for delivery. It belongs to someone, but that someone hasn't committed it. For eligible silver to become registered, the owner must agree to make it available and must be paid a premium to do so. That premium is rising. The cost of converting eligible to registered is increasing because silver owners know it's in demand. But here's the critical point. Even with conversions, total vault inventory is declining. Every month, more silver leaves the vaults than enters. The deliveries are draining the system, and the pace is accelerating. February is on track to be one of the largest delivery months in COMEX history. What happens if COMEX cannot meet delivery demand? What happens if someone stands for delivery and is told, sorry, we don't have the metal? That would be a default, a failure of the exchange to fulfill its core function. Confidence in paper silver would collapse overnight. Everyone holding futures contracts would rush to convert to physical. The paper price would become irrelevant. The physical price would be the only price that matters. And that price wouldn't be $82, it would be $150 or $200 or higher. Now, I'm not predicting a COMEX default in February. The exchange has mechanisms to prevent that. DXFSDGV 745B 20.3.320. They can raise margin requirements to reduce demand. They can offer cash settlements at a premium. They can source metal from the LBMA or other markets. But every one of those mechanisms signals stress. Everyone tells the market that physical silver is scarce, and that signal alone will drive prices higher. Watch the delivery data over the next 15 days. Watch how much registered silver declines. Watch how many contracts stand for delivery versus how many are settled in cash. If deliveries remain elevated and inventory continues dropping, you'll see silver break above $90 and potentially challenge $100 before month's end. Let me move to catalyst number 2, the Federal Reserve policy announcement on February 19th. This is only 9 days away, and the market isn't positioned for what might be announced. Right now, consensus expectation is that the Fed will hold rates steady. Inflation has been sticky, the economy has been resilient, the Fed has signaled patience, so the market expects nothing to change. But there are growing signs the Fed is more concerned about economic weakness than they're letting on. Employment data has softened. The January jobs report showed slowing hiring. Wage growth is decelerating. Consumer spending is weakening. The housing market is struggling with high mortgage rates. And there are increasing signs of stress in the commercial real estate sector. Banks have exposure to commercial real estate loans that are underwater. Some regional banks are facing pressure. Behind closed doors, the Fed is seeing data we don't see. They're seeing stress building in the financial system and maybe preparing to pivot earlier than expected. A pivot doesn't necessarily mean cutting rates in February, but it could mean changing language. It could mean signaling that cuts are coming sooner than previously expected. It could mean acknowledging that the balance of risks has shifted from inflation to recession. Why does this matter for silver? Because silver is a monetary metal. It competes with dollars for investor capital. When interest rates are high, dollars are attractive. You can earn 5% in a treasury bond with zero risk. Why hold silver that pays no yield? But when interest rates are falling, when the Fed is easing, dollars become less attractive. The opportunity cost of holding silver decreases, and investor demand for precious metals increases. Moreover, Fed easing signals money printing, expansion of the money supply, currency debasement. That's bullish for hard assets like silver that cannot be printed. Every time the Fed has eased in the past, precious metals have rallied into 2008 to 2011. Gold went from $700 to $1,900. Silver went from $9 to $40. 2019 to 2020. Gold went from $1,300 to $2,000. Silver went from $14 to $30. The pattern is clear. Fed easing is rocket fuel for silver. If the February 19th announcement contains any hint of a pivot, any softening of language, any acknowledgement that cuts may come sooner, silver will react. The reaction won't be gradual. It will be immediate. Algorithmic trading systems will detect the shift in tone. Hedge funds will pile into precious metals. The dollar will weaken, and silver could jump 5 to 10% in a single session. But there's another possibility that's even more bullish. What if there's an emergency? What if something breaks in the financial system before February 19th? What if a bank fails or a credit event occurs that forces the Fed to act urgently? In that scenario, the Fed might not wait until February 19th. They might announce an emergency rate cut or emergency lending facility, and that would signal to the world that the crisis is here. The flight to hard assets would be immediate and overwhelming. Silver would gap up and not look back. I'm not predicting a financial crisis in the next 15 days, but I'm saying the risk is elevated, the stress is building. And the Fed announcement on February 19th is a catalyst that could unlock a massive move in silver, regardless of whether there's a crisis. Even a subtle shift in language could be enough. Let me move to catalyst number 3, the implementation deadline for China's expanded silver export restrictions on February 25th. This is the catalyst almost nobody is talking about, and it might be the most important of all. On January 1st, 2026, China announced new export restrictions on silver. Only 44 companies are now allowed to export silver, down from over 300. But that announcement was just the framework. Implementation has been phased. Companies were given time to comply. Contracts already in progress were allowed to complete. The full enforcement of new restrictions takes effect on February 25th. After February 25th, the flow of refined silver out of China will drop dramatically. Companies still shipping under legacy contracts will stop. Smaller refiners finding workarounds will be shut down. The 44 approved exporters will be the only channel for Chinese silver to reach the global market. And those 44 exporters are large state-connected enterprises that will prioritize domestic demand over exports. China refines 60-70% of the world's silver. They're the dominant player in the global supply chain. When they restrict exports, the rest of the world feels it immediately. We're already seeing signs of tightness. Physical premiums in Europe and North America have been elevated. Dealers are reporting longer lead times. Industrial users are scrambling to secure supply. And this is before full restrictions take effect. After February 25th, tightness will intensify. Importers relying on Chinese silver will have to find alternative sources. But alternative sources are limited. Mexico and Peru mine a lot of silver, but they don't have the refining capacity China has. Switzerland has refineries, but they're already running at capacity. The United States has limited refining infrastructure. The supply chain simply cannot replace 60-70% of global refining overnight. What happens when demand exceeds supply? Prices rise. And when the supply disruption is sudden and severe, prices don't rise gradually, they spike. We saw this with rare earths. When China restricted exports in 2010, prices went up 10x in some cases. We saw this with palladium when Russian supply was disrupted. Prices doubled. Silver is next. The February 25th deadline is a hard catalyst. It's not a maybe. It's not a projection. It's a dated implementation of a policy already announced and the market hasn't priced it in. Most investors don't even know it's coming. When they find out, when they see the supply drop, when they see premiums spike, they'll rush to buy and there won't be enough silver to go around. Now let me show you how these three catalysts interact, because the power isn't in any single catalyst. The power is in the convergence. COMEX deliveries are draining Western vaults. Inventory is at historic lows. The system is stressed. Then the Fed announces a pivot signaling that dollars are being debased and hard assets are attractive. Investor demand for silver spikes. People try to buy physical, but then China's export restrictions fully kick in. The supply of refined silver to the global market drops dramatically. Demand is spiking at the exact moment supply is collapsing. In a normal market, these dynamics would play out over months. Prices would adjust gradually. Buyers and sellers would find equilibrium. But this isn't a normal market. This is a market with 66 paper claims for every ounce of registered silver. This is a market with massive concentrated short positions. This is a market where the physical is disappearing and the paper is multiplying. When these three catalysts converge, the market won't adjust gradually. It will break. Shorts will be forced to cover, but there's no silver to cover with. The price will gap up. Traders who are short will face margin calls. They'll buy at any price to close positions. The buying will push prices higher, triggering more margin calls, more buying. A self-reinforcing squeeze that could take silver from $82 to $120, $150, $200 in a matter of weeks. Let me give you the specific dates to watch. February 15th is the midpoint of the COMEX delivery period. By this date, we'll have a clear picture of how stressed the delivery system is. Watch the registered inventory numbers. If they drop below 25 million ounces, alarm bells will be ringing. February 19th is the Federal Reserve announcement. Watch the language carefully. Look for any hint of a pivot, any acknowledgement of economic weakness, any signal that rates may come down sooner than expected. If you hear phrases like data dependent in both directions, balanced risks, or prepared to adjust policy as needed, those are code words for a potential pivot. February 25th is the China export restriction implementation deadline. By this date, the full impact of restrictions will be visible. Watch physical premiums in Asia and Europe. Watch dealer inventory reports. Watch industrial user commentary. If premiums spike and delivery times extend, the supply shock is real. And watch the price action throughout this 15-day window. Silver is currently at $82 to $83. If it breaks above $90 with conviction, that's a signal that catalysts are beginning to impact the market. If it breaks above $100, the squeeze is accelerating. And if it breaks above $120, the previous all-time highs, we're in uncharted territory. The path to $200 will be open. What should you do with this information? First, understand that this is a time-sensitive opportunity. The catalysts are dated. Once they occur, the easy money will be gone. If you're going to position for this move, the time is now, not next month. Now. Second, decide how much risk you can take. If you're conservative, physical silver is the safest way to benefit. Yes, premiums are high, but if silver goes to $150 or $200, the premium you paid will be irrelevant. If you're more aggressive, consider mining stocks or options for leverage. But understand that leverage works both ways. You can lose money quickly if timing is wrong. Third, have a plan for volatility. The path from $82 to $200 won't be smooth. There will be pullbacks. There will be days when it feels like the thesis is broken. Don't panic. The fundamentals are intact. The catalysts are real. Volatility is the price of admission for extraordinary gains. Fourth, ignore the noise. Over the next 15 days, you'll see headlines designed to scare you. Analysts calling for crashes, mainstream media dismissing silver as a bubble, banks issuing bearish reports. They don't see what we see. They don't understand the catalysts. And many have incentives to keep prices low. Think for yourself. Watch the data and make your own decisions. The next 15 days could define your financial future. Three catalysts are converging. COMEX deliveries are draining the vaults. The Fed may pivot. China is cutting off supply. The conditions for a historic move are in place. The only question is whether you're positioned to benefit. Subscribe to this channel. Share this video with everyone who needs to see it. Drop a comment with your thoughts on these catalysts and how you're positioning. I read every single comment, and I'll see you in the next one.